Joining me now is Joyce Huang, Senior Client Portfolio Manager of Fixed Income at American Century Investments. Welcome to the show, Joyce.
Thanks, Ashley.
So the S&P 500 is hovering near record highs right now. What is driving the resiliency of the markets?
Of course, so as you mentioned, we got some good news, just some clarity around the uncertainty that's been driving volatility in the markets throughout this whole year. I mean, if we look at where we ended the end of 2024 to today, we had all-time high in the equity markets, close to 20% drop, and now we're back up close to all-time highs. So there's just a lot of uncertainty in the markets, and the more certainty we have, whether it's good or bad, and lately it's been good, is driving more sentiment higher.
We're at the heart of earnings season. What are you going to be looking at most closely?
So we are thinking about the employment picture because as fixed income investors, we're very focused on what the Fed could potentially do towards the end of this year. And while inflation is cooling, some sticky components we're still watching, but on the whole, that's resolved. The employment picture really needs to get worse before we will see the Fed really intervene. So I'm going to be looking for mentions of, hiring freezes, potential layoffs, the effect of tariffs on company earnings and forecasts, and how that might impact their employment picture going forward.
Speaking of tariffs, there's an August 1st deadline on reciprocal tariffs. What are investors pricing in, and how do you think that these can impact the markets?
Sure. So as I mentioned, on Liberation Day, we were looking at, the highest tariffs we've ever seen in a century, right? And of course, that was the worst case scenario, and the markets responded accordingly. As we've started to see deals being reached with some of our largest trading partners, Japan coming in last night, of course, at a favorable level, we do feel that the ultimate average tariff level is going to fall between 15 to below 20%, which is on the higher end of where we thought it might be post-election, but not as high as we feared post-Liberation Day. So that's good news.
Do you think the extra cost is going to be passed on to the consumer?
That's what we're waiting to find out too, and that's another thing we'll be listening for in earnings. Some companies are absorbing some of the extra costs. We know that consumers are starting to feel some stress, especially consumers in the bottom half of earners. They don't really have extra money to be paying higher prices due to tariffs. So we believe companies that are targeting lower income consumers are likely to absorb some of the extra increase, whereas we know luxury brands might be passing on more of the tariff costs to their consumers, given, again, the wealth effect. The stock market is back up. Everything seems pretty good, so we believe that the top 10% of consumers will remain resilient.
There's also a lot of eyes on the Federal Reserve. They've held interest rates steady since last December. Do you think they're going to be making cuts, and how many cuts do you anticipate?
Yes, so that is going to be dependent on the employment picture, as I mentioned. If we do see some weakening, as we at American Century are anticipating, we should see one, maybe two cuts towards the very end of the year. So maybe we'll get a little bit of a Santa Claus rally.
So you've said regarding the bond market that short-term pain is unavoidable. Why is that?
So we do think that you are going to see a bit of slowing in the economy, which will prompt the Fed to then cut rates. So you have to have a little bit of the bad before the good. So we also see credit spreads for both investment grade and high yield corporate bonds close to all-time tights. We expect that to widen as you start to see the effect of the tariffs coming through, as you see unemployment going up, as consumers cut back, and therefore you should see credit spreads widen. But as we've seen, pullbacks both in the equity and the bond market have been short-lived, and we do expect a strong rebound going into early next year.
And do you think the short-term pain can lead to long-term success in the bond market?
Yes, absolutely. I mean, when you look at yields today, they are extremely attractive. You're looking at over 5% yields on investment grade quality corporate bonds, securitized bonds. You haven't seen that type of yield available in the market since pre-08. So over the last 16, 17 years, investors have been struggling to get any income in fixed income, and now finally they're being rewarded for it. So the yield carry is very attractive right now.
Thank you so much to Joyce Huang, Senior Client Portfolio Manager of Fixed Income at American Century Investments.
Thank you.
Thank you so much for joining us.
Thanks.